I'm Charlotte McLeod with investingnews.com, and here today with me is Keith Weiner, founder and CEO of Monetary Metals. Thank you so much for being here. Great to have you.
Thanks for having me, Charlotte.
Of course, always really good to be speaking with you, and definitely it's been an eventful time for gold since we last spoke, I think all the way back in March. So we've made it a little way past the half-year mark for 2025, and I wanted to start by just taking a look back at gold's performance so far this year and seeing what you would pull out for investors to notice there.
So I think I might have discussed this last time I was on the show. We put out every year annual gold market outlook report, and which, it's kind of interesting because I do most of the writing in January, and then it's kind of edited, and I put together the infographics and stuff, and it comes out, I think, in late February, early March. And so there's this risk that I say something either already come true by the time it's printed, and everyone says, oh yeah, he didn't really stick his neck out this time, or the market's gone completely in the other direction and I look like a fool. But I think I said gold could hit $3,600 this year. And we got, somewhat close to that. We got to 3,500 anyway. Today, as we're speaking on Monday, August 11, it's down a bit. But, that happens. And I said if gold hits 3,600, we'll see the price of silver rise, but not as much by proportion. We could see $36 silver. Or $37 silver. I don't remember what I said anymore. And, we've hit that one. We're still a few dollars off the mark on gold. On the other hand, it's not the end of the year yet, so we'll see. But, we're particularly in gold, to a lesser degree silver, we're in a bull market, which really just is the inverse of, so bull market and gold sounds good, until you say, well, actually, that's just the inverse. We're in a bear market in our money, the dollar. So the dollar going down, you can't measure that necessarily against consumer goods. You can't necessarily measure that against the dollar derivatives, i.e. euro, pound, yen, yuan. You measure it against gold. And, where the dollar started before the madness of the Fed, it was 1,500 milligrams of gold. And we got as low as 9 milligrams before, picking up off the lows recently. But we'll go on to make more and more new lows. Will it hit 5 milligrams? Yes. Will it hit 1 milligram? Yes. Will we get into micrograms? Yes, eventually. It's exciting if you want to sell your gold and get more dollars. If you want to keep your gold, it's just the decline of the entire monetary system that we're in, and that's really what we're seeing. Gold doesn't go anywhere; it's a dollar going down.
Exactly, and I think that gives us a nice assessment of what's happening for gold so far this year and a base to work off here. We're going to get into, I think, a lot of the topics you mentioned, but I thought we could begin with some current events. Last time we talked, we spoke quite a bit about tariffs, and they're still really in the headlines right now. I think one of the latest ones that people are paying attention to is these Swiss gold bar tariffs. There's a lot of talk about that last week, and it seems like we've kind of reached a resolution at this point. But I'm wondering if you can go into that, explain it for people who might not be caught up on what's going on there.
Yeah, so this is one of those things where, unfortunately, there's a lot of bad takes out there in the gold community. And these bad takes all have the same recipe, which is something happened, and therefore, because something, that's going to cause the price to go up. It always leads to the price to go up. Good news, the price is going to go up. Bad news, the price is going to go up. No news, the price is going to go up. And so we thought that, when Trump took office, there was going to be tariffs on a lot of things, and there was a fear that that was going to include, gold and silver, which would have been really bad. It would destroy the futures market in the U.S. and force it to go somewhere else. And then we got clarity. No, it doesn't apply to the precious metals. Okay. And it doesn't apply to copper and some other things. Okay, great. Then, I don't remember when that was. Seems like it was a couple of months ago. It does apply to copper after all. So that's really going to kill everybody who manufactures with copper in the U.S. And, create some perverse incentives. So, cars don't use that. I'm trying to think of what really uses a lot of copper. but it'll make sense to manufacture that in a low tariff country and import it as a finished good rather than importing the copper and manufacturing in the US. So some very perverse incentives there. But we got on Thursday, it came out that some big trader or refiner had asked, I think it was the US Customs Agency, for a ruling letter to clarify the status of gold. They wanted legal clarity so that they're not risking not paying something they're supposed to pay. And, obviously they want to make their plans and their investments. Nobody wants to invest money only to be told by the government later, actually, your investment is rendered useless because of this tariff. And the letter came back and said that kilo bars and 100 ounce bars are tariffable. They're in the category that's subject to tariffs. Well, that sent the gold market into a tizzy, because apparently that takes effect immediately. All the stuff we had going on in December and January and February was a fear that tariffs would take effect later. And so everybody was positioning and repositioning for that. But this one it's basically 39% import tariff right now, because the trade is, and this is the thing people don't understand. Retail traders assume that all the other people in the market are doing the same thing they are. They think, okay, if I buy futures because the price is going to go up, someone is selling futures because they're betting the price is going to go down. Well, the people that are selling the futures short, yeah, there are a few that are betting. Mostly they're arbitragers. And the trade is buy gold in London, so you're long physical metal, and simultaneously sell a future short in New York. Now, what's the point of that? There's a spread. And normally when the interest rate's around 4%, that spread is around 4%, sometimes a little more. So you can make more than parking your money in T-bills by this arbitrage of carrying gold. Now, normally you don't have to think about the mechanics that you're long metal in London and short a future in New York, because the US has always been this open market. If you need to bring something in, you bring it in, no big deal. Now, with this tariff, 39% loss to bring it in for a trade that's 4% annualized. And if you're selling an October future short, it's basically 1/6 of that, or under 1% is what the profit is, for 39% loss. Completely unacceptable. You have to close that trade, and that's what happened en masse. So these are not short sellers trying to push the price down. These are arbitragers bridging the gap between spot and futures. And so to close that trade, you sell metal, which is pushing spot down just a hair, and you buy back because you're short the future. You have to buy it to close. You're buying it, lifting the future. So they widen this spread. The spread is called the basis. And in the October contract, for a brief moment early on Friday, that hit 11 or 12% annualized. Right? That should be 3.5 to 4.5% annualized. So a massive blowout in the spread. Price action over the 2 days, Thursday to Friday, total range of gold from low to high was 1.5%. And I think the gold price ended up within $10 on end of Friday of where it started on Thursday. There was no real price action. It was the spread that blew out, which means the market just became more difficult, much more expensive, and riskier for anybody who's using this market to hedge. So that would be a jeweler, a refiner, a mint, anybody that has an inventory position and come into the market and use this to hedge, now suddenly found that the market became way more tricky and difficult than they had bargained for. And even though I think the scare is over, the White House, I think, said we're going to issue, I don't know whether it's another executive order or what it is, that gold is not going to be subject to tariffs. Once you've put the scare into everybody, you can't just say, oh, sorry, just kidding. You can't really do that. And so now we've done damage. And, we'll see what happens to that spread over time. We'll see how, users of the futures market, adapt. There are other markets in the world that would be competing for this hedging business. Maybe it moves to Singapore, maybe it moves to Dubai, maybe it moves to London. And the U.S. loses not only a little more trust, but also a little bit of volume on what had been the biggest, or what is currently the biggest futures market. That's kind of sad.
Yeah, I think you're right. Maybe this scare is over for now, but it's hard to cram all of that back into the box once it's happened like that. I'm wondering, is there anything else you would add on tariffs, either for gold and precious metals or otherwise? I know right now it's still in flux, especially with US-China relations, and maybe that will be resolved by the time that we post this. But yes, anything further to add on the tariff situation unfolding?
I'm trying not to be political, but I'm an advocate of free markets and free trade. In fact, Springer just published a book, Free Trade in the 21st Century, and I contributed the chapter on the monetary system. So I'm a radical arguing for a free market and money and credit, which ain't nobody want that. So tariffs just make it more frictional. So whenever you add friction to a market, you shut down trade at the margin. It's the marginal deal that doesn't get done, the marginal good that isn't brought in. And Americans may not really think of it this way, but people who live in the rest of the world, there are certain goods that just are unavailable. So whenever people come to the U.S., they bring empty suitcases so they can go shopping. When sometimes goods are available, they're just way more expensive in the rest of the world than they are in the U.S. But the other thing they have is intermittent shortages. So there are goods that, yeah, they are technically available, but not always. And, the supply chains are creaky and rickety and unreliable because they're always working around some bureaucratic red tape or a tariff or this or that or whatever. And these decisions are arbitrary and capricious. They can shift quickly. And if it shifts against you, oops, there's this company in the supply chain that just went out of business because of that. And now for 2 months, you can't get those goods until somebody else tries to get into that business, see if they can make a better business of it than the last guy did. That's always going on in other places in the world, not in the U.S. Now we're starting it in the U.S. and Americans may soon discover, the joys of shortages and sky high prices for things and, less efficient markets. So I'd like to see no tariffs. I'd like to see free trade. And with that comes prosperity and with that comes peace. This leads in another direction, which ultimately ends in war, which I really don't want to see. But I don't want to dwell on that too much. Hopefully, we back off from this and we end up in a reasonable place. I don't know that, but I'm just expressing a hope. And of course, this is good for my business. We offer precious metals leases to these jewelers and mints and refiners. And so the more difficult it becomes for them if they borrow dollars, the more difficult it is for them to hedge the dollar exposure, the more attractive it is to lease the metal and forgo any need for hedging at all. So in a certain sense, I should be cheering it because they're beating up my competition, which will bring my customer straight to my door. I don't want to win that way. I want to have a better product, not have the government beat up my competitor. But that's the world that we're in right now.
Right. I do understand what you mean there. And I also want to get your take on the Fed and interest rates. So Fed still has not cut rates in 2025, despite all the pressure from Trump. And we have Powell saying, well, it's kind of because we don't have clarity on the tariffs. So I'm curious what you see happening with the Fed and rates moving forward, especially because we've had this latest jobs report that seems to have everybody thinking that the cut is coming at the next meeting. So what is your take on what you see playing out?
So I don't remember when Powell's term is over, but I think it's early in 2026. So he's increasingly entering his lame duck season anyway. And Trump is pretty good at character assassination and other things to marginalize people, even when they're not lame ducks. So I'd imagine that, there's just be more and more pressure, if not on Powell, then certainly the rest of the Federal Reserve Board of Governors, to make a move. Whether or not he can fire Powell, he said he can. Powell said, I'm not getting fired. I don't know how that plays out. Is that a constitutional crisis? I have no idea. But the broader issue that I see is that all of the economic pressures. Now, I'm a broken record. I've been saying this even before, Trump got elected, all through Biden, because Powell started hiking in 2022, is that the economic pressures are downward on interest rates. interest rates have to come down, and they will, and perhaps violently as they did in 2008. And so whether it's Powell, whether it's his replacement, whether Trump gets the credit or the blame, sometimes the perception of the politics can be quite different from the reality. But regardless of whatever will be the superficial reason, interest rates have to come down. And the reason is very simple. Now, for 40 years, we had falling rates. Okay, so from 1981 through 2022, rates have been falling. And every time rates come down, that enables the next marginal business plan. And that next marginal business plan has a slightly lower return on capital than the previous. And every time the rate takes down, the next lower return on capital is enabled. There's been an awful lot, trillions and trillions and trillions of dollars of business plans with returns on capital that are way below the market interest rate today. And that means they're just simply not viable at today's interest rate. So what business can afford to borrow? There is no business bidding up the interest rate at these rates. The demand for credit is soft unless the interest rate ticks down, and Powell forced it way up. So, there is going to be either just a mass wave of cascading bankruptcies or a lower interest rate, and possibly both, but they're not going to be able to hold the interest rate up forever. So I think interest rates are coming down. I think the longer they stay up, the more violent the drop in interest rates will be. I couldn't tell you when, but my weather sense, is telling me that that's probably sooner rather than later. I'm getting close to it now. I couldn't tell you that's going to be tomorrow morning. Probably not. Could it be in 2025? Increasingly possible, if not probable. If not 2025, something's telling me it'll be 2026 that we're going to see that happen, and we're going to see a return to zero interest rates and all the fun that brings, including booming prices, which everybody loves, and all the malinvestment that brings, and all the shenanigans and everything else. Now, there's two ironies to this. One is the false alternative debate of should the Fed be accountable versus independent, to which I say politicized versus unaccountable. And right now, Trump is saying it should be highly politicized, that it should be completely under the control of the president. Be careful what you wish for on that. The other is that most economists, and this is Keynesians, monetarists, and most libertarians, have the sign wrong on what they think the monetary policy response should be to inflation. They think that if we have rising inflation, you should have higher interest rates. Well, higher interest rates will destroy supply at the margin. What happens to prices if you destroy supply? Prices go up. So they've got that exactly backwards. If there's too much inflation, if inflation means rising consumer prices, and there's too much of that, you should want, and if you didn't care about all the other harms, and lowering interest rates cause many, many grievous harms to the economy. If you didn't care about any of those, you should want lower interest rates, because that's a subsidy drawing in more producers of more things. If I am the owner of a hamburger restaurant chain and I have 75 stores, of course I have in my back pocket a business plan for a 76th store, which I'm not building because the bottom, cell number A711 is red ink. The bottom line is it will not make money. But if you lower one of the biggest costs in that store, and one of the big expense items is interest expense. If you lower interest expense, then suddenly that red will take over to black, and it will be profitable to build that store. And so I and every other restaurant operator will borrow money to build another store. And the manufacturers of restaurant grilling and refrigeration equipment, and the manufacturers of restaurant plate glass windows, tile floors, lighted signs, you name it, all of which capacity for that will go up when the interest rate ticks down. And that's been a very pleasant, almost euphoric high for 40 years, as that's what we had. Now you want to start rising interest rates, you're going to have to destroy all of those businesses that were created in response to the falling interest rate. You have to destroy those businesses so that the survivors get a return on capital greater than the cost of capital. I don't think anybody's prepared for that kind of bloodbath. So yeah, interest rates coming down.
Right. And you answered one of my questions. I was going to ask you, okay, so how low can interest rates go? And you mentioned going back to zero, which we had before. I wonder if you can remind us, how does gold perform in that kind of environment? What are the implications for the gold price here?
Boy, is there a lot said about that. So one of our, I don't remember what year it was, we did different years. We looked at the alleged correlation of the gold price to everything that people suppose it to be correlated to, which is consumer price index, inflation, interest rates, both nominal, so-called nominal and real, quantity of money, you name it. And it turns out that yes, you can cherry pick a short-term, several years where the gold price has exactly the correlation you'd want it to. You can find another period of several years where the gold price has exactly the opposite of, correlation of what you'd expect. But over really long periods of time, it doesn't really correlate terribly well to any of those things, which is why gold makes such a great hedge in the portfolio. It's not something that goes down when stocks go up. It's not something that goes up when stocks go down. Yes, sometimes, but not others. It's non-correlated, which means sometimes it's correlated, sometimes it's anti-correlated. Sometimes it's doing it just its own thing. And so now I do want to clarify one thing. If the Fed says, okay, the period of tight monetary policy is over, we're going to do a new wave of quantitative easing. Yeah, I do expect that would be a real kick in the pants for gold. And we'll see the price shoot up. But is that going to be durable? Is that going to be massive? Not necessarily. Look at the period 2009 to 2018. Yes, there was all sorts of easing and they had different programs and they didn't call it quantitative easing after a certain point, but certainly the quantity of what we call money was spilling into the market without any particular bounds. And the gold price was not really all up after 2011. It was basically sideways and down. And so we came down from a high of almost $2,000 to a low of just over $1,000 during a period when the quantity of money was certainly increasing. And the interest rate was zero almost the entire time, as well. So, yes, I think the return to zero will be a boost. That's as sure a bet as anything would be in trading, which is to say, be really careful and don't do too much on margin. Not necessarily if we have a protracted period of zero interest rates, it doesn't mean the gold price is going to be skyrocketing the whole time.
I think really good context there. And we've kind of covered some of the big headline moving news for gold at the moment, but any other factors that you are keeping an eye on right now that you think investors should be aware of for gold?
Let me talk about kind of the difference of silver versus gold. Silver is much more the working person's precious metal. And when you start to see the jobs market, which wasn't really all that strong for, blue collar, trades. Yes, certain trades at certain times, if you're in the building trades in certain booming cities, I'm sure there was unlimited work. There was a period of I'll call it the unlock whiplash after COVID lockdown was over, where, truckers, had all the work they could handle and more. But overall, the market for, people that are working with their hands or doing a skilled trade, just not been that strong a market. Now, certain niches within white collar knowledge workers like AI, scientists right now are getting these like $100 million packages. It's almost like reading about sports stars. And you read about Michael Jordan getting a package like that, and now it's like these AI guys are getting it. But silver is the savings of tradespeople and blue collar workers. And now we're seeing the job market roll over, and that's going to hit, that segment, hard. And in addition, silver has this industrial component. And if manufacturing and all those other things are rolling over because of tariffs, for example, and also because this boom is just really long in the tooth. We're basically in one long boom, that was juiced up when in spring, or was it March, April of 2009, the Financial Accounting Standards Board said you don't have to market the losses. And so the banks were able to restate their financial statements, and suddenly they looked a lot better. And that was pretty much the day that the market turned around and began to boom again. So we're in this hell of a long time, 16 years and counting of boom, which is very long by any historical standards. I think we're well into record territory. So that we could be rolling over just because of that. Tariffs aren't going to help, all kinds of other things. And so silver, because of manufacturing demand falling off a bit, and because of working people savers just having less to save, I would generally expect silver to underperform. Now, could silver outperform in the short term? I think there's a lot of forces building up to suggest it could. Because the asset speculative class is seeing silver now. So if they jump into it, almost anything's possible in the short term. But gold, yes, because all the currencies, are made in this horrible bear market, and every government around the world has gone all in on madness, and it's getting madder, right? So we elected Trump as a protest against the profligate, stupid spending of the Democrats. And what do we get? A big, beautiful spending bill that accelerates spending even more. And of course, gold responds to that, because it's just, it's just a hedge against being a creditor to the government, which is what, if you hold the dollar, you're effectively a creditor to the government. And when the government's becoming something that embarrasses even drunken sailors, you don't want to be a creditor. Well, look around. What asset can you buy that's a financial asset that isn't being a creditor to the government? It's gold. So yeah, we're in this gold bull market. Silver, I think, medium to long term, not really. Maybe it'll keep up with gold to this point. It's not going to outperform. Short term, yes, there could be a big pop in it. That wouldn't surprise me, given everyone can see the chart patterns and say, wow, silver's going to pop. And then they'll make it pop, right? But, is the real long-term demand there for it? Gold, yes. Silver, I think less so.
Just a little bit of follow-up on silver, because we get a lot of questions from our audience on what's going on there. So we did see some excitement early in the year. We got almost to that $40 level, which seems to be a crucial point that people look at. What do you think was driving that move? I know you mentioned also it got a little bit beyond where you thought it could already this year.
I mean, there's a point at which there isn't even necessarily an explanation. The silver people will talk about structural deficits. Now, they've been talking about structural deficits since before I got into this. I sold my company in August of 2008. So we're exactly 1 week away, a week and a day away from the 17th anniversary of that sale, right? That was August 19, 2008. And when I started reading about this stuff in fall of 2008, they were talking about structural deficits for silver. Now, if the price moves, especially sharply in a short period of time, you can't look to a 20-year-old story as the explanation. It's like the left says, consumer prices went up this month because of greed. Wait, are you saying there wasn't any greed last month, and this month greed came into the market and that's why prices went up? Like, if there's something that's basically a constant, greed is a constant. And the alleged structural deficit in silver is a constant as well. It doesn't explain change to the margin. So a lot of people may cite that, but at some point sentiment, takes over, and then everybody, wants to buy. Yes, it's true in places like India, if gold is perceived to be too expensive, and it's also out of reach for, very large numbers of Indians just don't have. A minimum wage in India is between $2 and $5 a day. So it doesn't afford them, much if any gold. Silver is much more affordable. So, if gold becomes less affordable, there'll be some switch to silver at the margin there. That's true. And that can drive it a little bit. Silver is a smaller market. But at the end of the day, I think it's sentiment. The sentiment can be self-fulfilling for some period of time. As it was I mean, I think there was non-sentiment factors as well in 2011, but look at what happened to silver in the first part of 2011. Right, we shot up in late 2010. Silver was under $20, and by was it March? Did it hit peak or April in 2011? It was $50. So boom, 2.5 times. And then we spent how many years in a bear market in a silver wilderness? So the sentiment, when it turned. It was done. And that first day that silver dropped from $49 to 30, was it 35 or 34? It's like within a day. And all the smart people were like, silver's done, stick a fork in it. It's not going to recover the $50. This is not a market correction. This is wicked volatility. This is a bear market. If you have a loss, take your loss and move on. If you still have a gain, lock it in and move on. This thing is done. And it was for a long, long time. We still haven't recovered. 17 years later, we're getting closer to recovering. Could it go to 50 and beyond? It could. Will we see 30 on the gold silver ratio again? No way. To see 30 on the gold silver ratio, we'd have to see over $100 in silver. Keith Weiner, August 11, 2025. You're not seeing $100 on silver anytime soon. Not going to happen. It is what it is.
Okay, that's the call there on silver. And just a little bit more on the note of prices. So you said at the beginning of the year, you do your price outlook for gold and silver. Silver, we surpassed it. Gold, we're still waiting for 3,600. Are there any adjustments there that you would make now that we're kind of, well, as we said, a little bit past that halfway mark of the year?
Obviously I could adjust my silver up, a bit. I mean, it wouldn't surprise me to see 40, 42, who knows, maybe 50, right? I mean, and I didn't say silver wouldn't, I said just basically don't bet on it. I mean, price action to a fair degree is random, and everybody is pretending to be this prestidigitator. It's not that scientific, right? I can look at it and say, well, here's what the fundamentals are, and we have our fundamental model. But you get all kinds of random things, and the sentiment can take over all that. So yeah, silver surpassed it a bit. Could it go more? Yeah. Will it? Yeah, probably. I think silver is bullish at the moment. Gold at the moment, I mean, today, price of gold's down 2%. Will it be up 2% tomorrow? I don't know, maybe. But, we're in a bull market, a long-term bull market for all these reasons, and probably both metals. I'm just less excited about silver, for these reasons. But yeah, I think in both metals. And, for the rest of the year, would it surprise me if we fell short of 3,600 in gold? No, it wouldn't. Would it surprise me if we surpass 3,600 and we resume the march up and we see 3,800, 3,900? No, it wouldn't surprise me either. I haven't done, I guess the caveat to all this, when we do the annual report, I spend quite a lot of time looking and studying the markets. At this point, we're in a precious metals leasing business. We don't really have a business in speculating on its price one way or the other. We used to run a little hedge fund to play the gold silver ratio. So I'd be studying this every day. I'm not doing that anymore. I'm building and growing, fixed income business. And so this isn't the thing I focus on. So I haven't given it that focus right now. I'm speaking off the cuff. We're still in a bull market. We're relaxing at the moment for the next leg up. Yes, obviously. Will there be a next leg up? Yes, there will. Will that resume September 15? I can't tell you that. Versus October 1 versus October 15. Yeah, maybe, probably. But, these things are not predictable to that degree of precision. They just aren't.
Well, I really appreciate the openness on that. And I think we've gone through quite a number of factors on the gold and silver side. But before I let you go, are there any thoughts that you would leave investors with right now?
Just something I've tweeted about on and off a few times. If you're not earning interest on your metal, the only way you can profit from it is by selling it. And so it's sort of a a backdoor way of promoting monetary metals by saying, do you really want to sell your gold to get more dollars? And if you do, great, have at it. But if you want to keep the gold for all those reasons, put it to work and get 4% interest on it. It's kind of our proposition, but it really fits this macroeconomic, environment. Where I think the difference, and this is another major factor in why this is such a bull market, is, in previous times, there was always a sense of it's going to go up, play the waves, and everybody was happy to then sell it and get the dollars again. And so, of course, that selling is what limited the bull market in the end. But I think there's now more and more people that are just like, bleep that, the dollar is just bleeped. Let's have a gold position as permanent, not as a play on its price, just because we don't want 100% exposure to the dollar. And if that's the case, then you can't profit from it because you can't sell it anymore. Well, then put it to work. And I think people are holding gold for that reason increasingly, and around the world, not just here in the West. And they're coming to monetary metals for that reason too, because the proposition is more compelling. If you think you're going to sell it next week, who wants to get into a 1-year lease agreement? If you think, okay, I'm going to hold this and pass this to my kids, and I'm going to tell my kids, don't you dare sell it, then all of a sudden a 1-year lease doesn't seem, a big commitment anymore.
Yeah, that makes a lot of sense. That's a really interesting shift that you highlighted there. So, well, thank you very much for coming on today to go over what's happening in the precious metals market. This was really valuable.
Thanks for having me, Charlotte.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Keith Weiner with Monetary Metals.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.